So there is really a lot of discussion about whether or not to rebalance portfolios, with some critics even arguing that it diminishes return. And that can be true. I'll be the first one to admit that. So it's a hard thing to do sometimes, to rebalance a portfolio, because people generally don't like to sell their best performing investments because of the idea that they will just continue to go higher. And they don't want to pay taxes on any of the gains that they might lock in. Well, the bottom line here, and the reason that we advocate for rebalancing, is that stocks have outperformed bonds over time. If you look at different portfolios, if you look at a 100% fixed income portfolio, the long-term average comes in at around 5%. If you look at a 100% stock portfolio, like if you're looking at one of the indices, you'll see that long-term averages are about 10%. So equities outperforming bonds by about 100%. Therefore, if you start with a 50-50 allocation, 50% to bonds, 50% to stocks, and never rebalance, you're going to end up over time with only 20% in fixed income and 80% in stocks. Therefore, that kind of supports the argument that if you don't rebalance, you're going to end up with a higher average return. The big problem here is that volatility increases as exposure to equities increase. What do I mean by that? Well, I've got another visual if you're watching. If you go from the top to the bottom of the chart, from all bonds to all stocks, as I just mentioned, your average return increases from 5.3% in an all fixed income, all bond portfolio to 10.3% in an all stock portfolio. But look what happens to the volatility. So if you can see the yellow and the purple, look how those volatility ranges widen as you get closer to the bottom. So here's the bottom line. Volatility is your friend when you're accumulating money. That means when you're younger, when you're putting money away every month and you're not using that money. You're not taking money out of the investments, and because you have time to recover if you hit one of those negative 43 years. But volatility is a formidable foe when you are withdrawing money. So what happens over time, remember I told you if you never rebalance, you end up, if you started at a 50-50 portfolio, you end up with a 20-80 portfolio with much more exposure to equities, much more exposure to the volatile part of a portfolio. And when you're under 50, you could get away with rebalancing your portfolio as little as once a year. There's not that great of an emphasis on that, unless you're just really averse to seeing volatility. If seeing one of those negative 43 years would cause you to completely abandon your investment strategy altogether, then it is more important for you to rebalance. But as you approach retirement and get into retirement, there is much more value in downside protection than in capturing every bit of upside potential. So risk management during the first 5 years prior to retirement and all years in retirement are very, very important, because withdrawals exacerbate downside volatility. In other words, when you have to sell part of your investments in order to generate cash for your withdrawal, those withdrawals never have the opportunity to recover. So if you're in withdrawal mode and you have a possibility of experiencing a negative 40 or 50% downside in any given year, that is a huge blow to your retirement.